Hello, I'm Allison Schrager, and I'm a senior fellow here at the Manhattan Institute, and welcome to the Shadow Open Market Committee's latest panel, the Fed's Inflation Challenge. The Shadow Open Market Committee, under the auspices of the Manhattan Institute, is an independent group of eminent economists who have expertise in monetary policy and a lot of experience as policymakers. And it provides external perspectives on policy issues by the Federal Reserve and other leading central banks. And today's panel or panels can't be better times. We have the latest inflation report that show that PCE inflation is still high. In the meantime, GDP is weakening. And next week, the Fed is expected to increase rates 50 basis points. But many people are concerned that that's not going to be enough. Inflation is the highest it's been in more than 40 years. And this poses a big challenge to the Fed. Not only can it steer the economy out of inflation without causing a major recession, but also between missing its target for many years and now being dismissive of the inflation problem and now being well ahead of inflation, it also is a big blow to its credibility, and it requires some reckoning of how it thinks about inflation and perhaps maybe its policy goals and objectives. So we have a tremendous group of people to discuss this. Well, first we have some of the shadow members discussing the different objectives the Fed can pursue and if it should rethink that. And also then we'll discuss how it should be setting expectations and what it can do to deal with inflation. And then the last panel will be three former FOMC members, Bill Dudley, Jeffrey Lacker, and Charlie Plosser, to further discuss what the Fed can do and what it should do going forward to retain its credibility and to its ability to conduct successful monetary policy. So I'll leave it to Michael to take it away. Thank you for joining us.
Okay, thank you. Well, here we are. It is 2022, almost 50 years after Carl Brunner, Alan Meltzer, and Anna Schwartz founded the Shadow Open Market Committee. And the reason that they did that was because the US was embarking on out of control inflation. The chairman of the Fed at the time, Arthur Burns, blamed the inflation on non-monetary forces, greedy labor unions and big business. And he viewed the solution as wage price controls. Well, today, until very recently, the Fed viewed inflation as mainly transitory, reflecting pandemic-driven supply shocks. Our group has been pounding the inflation war drums for 18 months now, and now finally the Fed's beginning to listen. The history of Federal Reserve exits from recessions for the past 100 years, and Aunt Mickey and I have a paper on this, suggests that they really have blown it this time. So let me turn to our first panel. It'll be Mickey, Andy, and Peter. So Mickey, take it away.
Okay, thanks very much, Michael. So I'm just going to provide some general overview observations about inflation, labor markets, and the Fed's dual mandate. So just in summary, and Andy, you could share those slides. In summary, inflation has soared and become pervasive among major categories of goods and services. And to date, we've had the fastest inflation in goods prices, and now service inflation is accelerating and catching up. If we look at, and I'll show you a picture of it, the shares of the CPI and PCE components. Andy, go back to the first slide. Oh. The shares of the components experiencing high inflation are rivaling those of the late 60s and early 70s, but not yet the late 70s. So inflation is definitely a problem. Labor markets, by every measure, reflect robust demand, supply shortages, high quit rates, and we do have declining real wages. And so, just in summary, the high inflation reveals the flaws of the Fed's new strategic framework approach to achieving the dual mandate. And Charlie Plosser and I have written about this. Next slide, Andy. So this just shows simply the PCE inflation and the CPI inflation. And while the Fed focuses on the PCE, it's important to put both of them up here because the PCE price index reflects prices of all consumer expenditures, including those items like healthcare under Medicare and Medicaid and employer subsidized contributions to healthcare. And so whereas the CPI measures consumer out-of-pocket expenditures. So while the PCE is the focus of the Fed, consumers' out-of-pocket expenditures are going up by much more, according to the CPI, and that's an important distinction. Now, next slide. What this next slide shows is if we break down, and these are available in the BLS's and the BEA's details. The left-hand chart shows the portion of the PCE components, about 190 components that are experiencing inflation above 3% and above 5%. It goes all the way back to the 1960s. And the key point here is you can see the pervasiveness of inflation is is close to the late 60s, early 70s, but not as high as the late 1970s. The shares experiencing higher inflation in the CPI are higher, but keep in mind the CPI shares tend to be more heavily weighted. This includes over 200 components, more heavily weighted in the food categories, and they're not expenditure weighted. But simply put, you look at these slides and you just see clearly that the pervasiveness of inflation is spreading, and it's not even mid last year when the Fed and the Biden administration said, "Oh, it's just one-off due to a few select items." Those statements were absolutely inconsistent with the data. Okay, moving on to labor markets. I mean, we've seen this very strong growth in employment, decline in unemployment. It has been an inclusive and robust rebound. The only lagging indicator has been the labor force participation rate shown on the right, which has lagged behind. But I would note that when you break it down by demographics, the big shortfall in the rebound of the labor force participation rate has been by older people, and maybe they have retired, but this may suggest further constraints on labor supply. And then the last chart on the next page just shows on the left the job openings just far above hires. At the same time, you have very high quit rates. That is labor market churn that's making it very difficult for businesses to maintain staffs. And then on the right-hand side, what I show here is the total job openings. And then in the yellow, in the orange line, or excuse me, in the black line, is the total number of people who were unemployed, measured in the labor force, plus those people in the not counted in the labor force who said they would like a job, but just aren't looking for one. And boy, are labor markets tight. We can expect they're going to remain tight. And even if you have a slowdown in economic growth, labor markets are going to stay very, very tight. And so that just summarizes the view of inflation is far above where anybody had expected. I do expect inflation to begin coming down in the second half of this year, but remain significantly above the Fed's forecast of inflation and consensus view on inflation. I'll stop right there.
Okay, so it's Andy's turn.
Okay, great. Well, let me just start by thanking the Manhattan Institute for hosting us, and to really thank our guests, former President Bill Dudley and former President Jeff Lacker, that we're going to hear from in the next hour, but I want to share with you some really new work. Just put up my slides here. This is joint work with Bill Nelson, who is at the Bank Policy Institute, and Brian Liu, who is a super talented undergraduate student who's just about to graduate from Dartmouth. Just to emphasize that these slides are my own comments, but the paper should be ready in the next several weeks. And so if you're interested in this work, just let us know and we'd be happy to send it to you once it's ready. So just to review here, a few key points that are familiar to you, but just to emphasize them. The Fed's balance sheet has grown by a factor of 10 since the time before the global financial crisis. It's also shifted dramatically. It used to be treasuries only prior to the financial crisis, and treasury bills was a big fraction of that. Now treasury bills are tiny, and most of the balance sheet is mortgage-backed securities and treasury notes, which means things that are say 2, 5, 10, or longer maturities. The duration of the system open market account has increased dramatically. On the liability side, the Fed's balance sheet used to be really simple because it was almost all cash. There was a tiny amount of required reserves, just minuscule amount of excess reserves. And there was some reverse repos, but basically the balance sheet before the financial crisis was almost all non-interest bearing, which meant there was no interest rate risk for the Fed at all. And it made sense for it to hold longer term treasuries as part of its portfolio against the paper cash. Since that time, things have changed. It's not just the size of the balance sheet, the composition has changed. Now 3/4 of the Fed's balance sheet is interest bearing liabilities. So in effect, what you can see here is the Fed looks like a hedge fund. It's borrowing in short-term maturities, mostly overnight, and it's investing in longer-term securities like mortgage-backed securities and longer-term treasury notes. So that means interest rate risk is a much, much bigger, more important thing than it's ever been in the past. Okay, so our paper, we do a pretty technical analysis. I'm happy to answer questions about it, but just briefly, we take all the individual CUSIP level security information from the New York Fed. It posts on a weekly basis, all of their holdings. We also use data from Bloomberg and Orphanides, and we construct a baseline projection, a complete projection of the Fed's balance sheet over coming years, where we're incorporating the normalization principles that the Fed just adopted and published in its minutes a few weeks ago. In addition, we construct a counterfactual projection. And the idea of the counterfactual is, well, what if the Fed hadn't done QE4? What if they had responded to the onset of the pandemic as lender of last resort, but they hadn't accumulated, multiple trillions of dollars in security purchases at that time? Okay, and so I'm just going to be very brief here, and again, I'm happy to answer questions or get into more details later, but this shows you the overall size of the balance sheet in terms of assets over coming years. And what you can see is that, as was emphasized in the Fed minutes a few weeks ago, the size of the Fed's balance sheet will start to look pretty normal again by around 2024, 2025, pretty much back to the counterfactual scenario where there wasn't a QE4. But what wasn't emphasized very much in the minutes, and I think it's important for people to understand, is the composition of the balance sheet is going to take a very long time to normalize. If we're thinking of a composition where the MBS are gone, that's going to take decades probably, because MBS are very illiquid, they're not easily sold, and they roll off slowly, and perhaps even more slowly now, because with mortgage rates going up, then there's fewer refinancings and less prepayments of principal. And on the treasury note side, those things do roll off slowly, but to get back to a composition where treasury bills are a substantial fraction of the treasury holdings is also going to take many, many years. Now, what are the consequences for the Fed's net interest earnings which in turn is essentially a small fraction of it covers the Fed's operations. Most of that is paid in remittances to Treasury. And what you see here is a huge cost of QE4, an immense, just unbelievable cost of QE4. It's the gap between the red line in this picture and the green line. And in a typical year here, over the next few years, that gap is going to be on the order of 50, 80, $100 billion. Those are real costs. They're going to ultimately be borne by the US taxpayers because this is less money that will be paid. If the Fed hadn't done the purchases over the last couple of years, we would be on the green line. That would be a scenario where the Fed's earning money because it has non-bearing cash, and it's able to use those funds and invest in Treasury securities. And that's the normal times the Fed's done. And that's not what we're going to see for the next decade. The simple logic here, of course, is the Fed bought a lot of securities in 2020, early 2021, when yields were below 1%. And now we're heading into a world where the Fed's going to probably have to raise rates to 3% or maybe quite a bit more under the Taylor rule. The Fed would need to raise rates to 5% or 6% or 8%. And so the market value of these securities that the Fed purchased during QE4 has already dropped by roughly $500 billion. And if, in fact, over coming months, it turns out the Fed needs to tighten further just to get to neutral, you can easily see a scenario here where the total cost of QE4 to US taxpayers could be $1 trillion. If I say that should raise eyebrows, it's an understatement. Okay, that the Fed could cost US taxpayers $1 trillion. Now, what I just want to emphasize here is this is actually not a new message. Bill Nelson has been warning about these interest risks that the Fed's been taking on multiple times over multiple years. Most recently, it was covered in a very nice commentary by Grant's Interest Review. But you should contact Bill directly and get onto his email distribution list. And I know Bill's eager to engage with people and explain more of his thinking. So just to wrap up, I think there's some very important conclusions here about governance. It's important to protect the Fed's independence. The Fed is the agency that's responsible for price stability and a dual mandate of maximum employment and price stability. It needs to have independence to do that. But the Fed should not have authority to spend $1 trillion in taxpayer money without consulting with Congress. So having new FOIA rules to govern the Fed's operations, having a GAO comprehensive review, and possibly having some changes in the Federal Reserve Act that would put some constraints on the Fed. These are things Charlie Plosser and Jeff Lacker have talked about for many years, maybe requiring the Fed to have a treasuries only portfolio, maybe requiring that its interest bearing assets should be matched to interest-bearing liabilities with a similar maturity. Those are all very reasonable things that should be pursued that I think would be helpful in sustaining the Fed's longer run independence. So I'll stop there.
Okay. Thank you, Andy. Let's turn to Peter now, please.
Thanks very much, Mike. I have just one slide that I'd like to share. Let's see if I can pull it off. Okay, so I do have a little paper to go along with today's presentation. It's called The Continuing Case for Nominal GDP Level Targeting. You can find it on my website, also on the Shadows website. Do a Google search and it will pop up. But in it, as the title suggests, I argue that by announcing and making consistent reference to a multi-year target path for the level of nominal GDP, like the one shown here over on the left, the Federal Reserve could have made monetary policy more successfully in the aftermath of the spring 2020 shutdowns, and could, by extension, continue to make monetary policy more successfully looking forward. So what exactly are the arguments? How do they work? Well, like the strategy that actually was used over this most recent period, flexible average inflation targeting. Targeting the level of prices or the level of nominal GDP would have appropriately allowed the Federal Reserve to keep interest rates lower for longer than implied, let's say, by a standard Taylor rule specification, for the obvious reason, as you can see over on the right-hand side, by the second quarter of 2020, the US economy had fallen into an enormous hole and needed extraordinary levels of monetary support. The problem, though, with flexible average inflation targeting always was its incompleteness. It lacked a built-in exit criterion. In describing flexible average inflation targeting to the public, and maybe even to themselves, FOMC members were never clear about exactly how much extra inflation they'd be willing to tolerate in order to make up for past misses. So then when inflation did accelerate markedly last year, they were caught off guard and slow to react. Now, with a more explicit level target, remember, monetary policy should be all the way back at neutral, not just starting to normalize, but all the way back to neutral when the targeted value converges back to the target path. And for nominal GDP, at least the way I've drawn the graph here, that would have actually occurred sometime in between the third and fourth quarter of last year. Now, of course, the policy prescriptions coming off of a scheme like this one are going to depend on the details of the strategic design, whether you're targeting the price level or nominal GDP, the slope of the target path, and perhaps most importantly, the base year used to anchor the level of the path. Nevertheless, in the paper that I referred you to earlier, I show that under any reasonable configuration of choices for those various parameters, an explicit level targeting scheme would have signaled the need at a minimum for a start to policy normalization much earlier, at some point in the second half of 2021. So if there's one point that I'd like to make and emphasize more than any other this afternoon, it would be this one. FOMC members always resist calls to make monetary policy with reference to a specific pre-announced rule. And the argument that they always make against a rules-based approach is an appeal to real-world complexity. The notion that there are just too many contingencies that you have to consider to trust, so to speak, monetary policy to a simple rule. That is why, according to conventional wisdom, ample room must remain for discretion. Now look, the argument makes sense in theory, but as Milton Friedman always emphasized, the key question then becomes the empirical one. In practice, do the Fed's discretionary actions help or hurt when it comes to achieving the Fed's stabilization objectives? In his look back at US monetary history, often with the help of Anna Schwartz, Friedman found more often than not discretion made matters worse. And regrettably, we seem to have seen another example of exactly the same in the most recent episode. So, lesson to be learned or relearned from recent experience: monetary policy does work best when it's conducted in a rule-like way. Discretion, however well-intentioned, more often than not, counterproductive. Now, one last question. How come a target for nominal GDP instead of the price level? Well, again, in the paper, I list a number of reasons, but chief among them is the issue of supply shocks. Even though last year's debate over transitory versus persistent inflation does seem to have been resolved pretty emphatically in favor of the persistent side, it is still nevertheless true, maybe even more so now than last year, that measured inflation is being pushed higher, in part by adverse supply shocks as well as overly accommodative monetary policy. One of the biggest advantages of nominal GDP targeting, though, is that when an adverse supply shock hits, that does tend to increase measured inflation, but it also slows down the rate of real economic growth, muting the overall effect on nominal GDP. So by tracking nominal GDP relative to a target path, FOMC members could help themselves see through the effects that adverse supply shocks are having on measured inflation and keep their focus on intermediate term trends, which after all are the appropriate domain for monetary policy making. Thank you very much.
Okay, so we can open this up to the whole panel. So are there any comments that maybe some of the other SOMC people want to make? And there are a bunch of questions that are coming in now, but maybe we could just see if there are any other comments coming from other people on the shadow, and then we can go for the questions. Anybody? Yeah.
I have a comment. For some reason, my video is disabled and I'm not able to enable it. This is Charles Calamiris. Let's see if it works now. Good. And my question has to do with Mickey's observation about the pervasiveness of inflation and the Fed's inaccurate statements, not just inaccurate forecasts, but inaccurate statements about that pervasiveness. And I just want to invite Mickey to comment a little bit about the huge misses in forecasting that the Fed has had, and also the private sector. And one of the things that's always been striking to me is both Mickey and a researcher at the Dallas Fed pointed out that the acceleration of services inflation was actually predictable on the basis of the predictable increase in rents that happen several months after increases that are observed in house prices. And this is a big component, of course, of the price index. And it really is a big part of the story of why we knew that inflation was going to accelerate. And yet it seemed like forecasters completely missed it. So I'm very puzzled by the misses. I don't think that they're so easily explained, but maybe Mickey has a different idea.
Well, Charlie, let me just start by saying, forecasting is very, very difficult. And it's always challenging, but particularly following the pandemic, it was particularly challenging. But my perception is, what was so striking through, really going back to September of 2020, if you look at each succeeding Fed quarterly update of its SEPs, that it adjusted its inflation forecast for 2021 to reflect what had already arithmetically happened, but it always had its intermediate term forecast of inflation going back to 2% immediately. And that's very perplexing, not just with the unprecedented amount of fiscal stimulus deficit spending, but also ongoing monetary accommodations. It was almost as if you had this unprecedented deficit spending that was financed by the Fed, and the Fed forecasters assumed that the fiscal multipliers were close to zero. And in thinking about this, one of the factors that I think led the Fed astray, and many forecasters astray, is that there was this general presumption that inflation would repeat its pattern from the post-financial crisis, when the Fed conducted QE2, QE3, kept rates at zero, and inflation didn't rise. And the Fed has this, and they express this in their new strategic strategy. There was a clear concern about inflation being below 2% and the risk that inflationary expectations would collapse. But I think it was this presumption that inflation would stay low, carried into their forecast in 2021, so that when inflation started rising, they explained it away because their anchor was this presumption that inflation would stay low. And I think that fed into their persistent argument that it was due only to supply shocks. At the same time, Peter just showed in his charts, and if you instead of looking at nominal GDP, if you were to look at final sales, excluding the decline in inventories, you had the fastest growth in final sales in US history, and the Fed refused to acknowledge that there was any demand driven there. So, just let me stop there, but say, I think a lot of it was just the perception that we would follow the same pattern really led the Fed astray.
Yeah. So Debbie Lucas has a question that she's in the chat that she posed for Andy Levin. So I thought that's pretty interesting. Maybe we should make that, available to everybody. So Debbie, do you want to repose your question?
Sure. So I was just discussing the whole issue of gains and losses on the Fed's balance sheet. So it's an issue I work on quite a bit myself. So I have a strong view on it. And so while I do agree that the kind of the carry trade that the Fed does by generally borrowing very short term and then lending long term, and then Congress turns around and books that as a profit, which is totally inappropriate. And so in an accounting sense, that helps the government and it doesn't. But if you want to think about the real effects of all of that on the government, I think you have to look at a consolidated balance sheet approach. So in terms of those longer term Treasury holdings where the Fed has taken a capital loss, the good news for the government is on a mark-to-market basis, the outstanding Treasury debt is that much cheaper. So when you consolidate the balance sheet of the Fed with the balance sheet of the Treasury, all of that actually makes no difference. Now, on the MBS holdings, that's not the story, because to the extent that the Fed buys securities, mortgage securities or any other private security, there is truly a gain or loss because the Fed is representing the government and it's facing the private sector. So that's kind of a synopsis of what we were chatting about. And Andrew was disagreeing, so he probably needs to say something too.
Well, I think in my own experience, it's actually much more straightforward just to talk about the Fed's net interest earnings. And that's why I think it's helpful to look at the counterfactual. If the Fed had done this, okay, because during normal times, the way things have worked for decades is the Fed's main liability is paper cash. It doesn't pay interest on that. And because paper cash has generally tended to grow at a fairly steady pace over time, the Fed can essentially hold the corresponding asset in medium and longer term Treasury securities, at least a lot of it. And that has a net interest income to the consolidated government balance because you have an interest, the central bank is able to issue liabilities that people want to hold that are not interest bearing. In effect, what's happened in the last couple of years is that the Fed has spent probably, let's say, 10 years worth of the net interest income on paper cash. It has spent that in buying a lot of longer term securities when yields were very low. Now, there is a question about what's the coordination between the Fed and Treasury, and someone in the audience also asked that question. And frankly, I think a big part of the problem here is that coordination it's very opaque. To what extent, if the Fed is in effect undoing the Treasury is trying to issue a lot of longer term debt to take advantage of low yields, and the Fed's undoing that by buying up a lot of those longer term securities and instead issuing overnight liabilities, say reverse repos and bank reserves. In principle, the Treasury could then respond to that by saying, well, now we're going to issue even more longer term debt. I think in practice, the Treasury has promised and the Fed has kind of jointly promised to say, we're going to take each other's policies as given. We're not going to get into a fight with each other. We're not going to try to undo what each other's doing. And if that's true, then this is a real cost to the taxpayers. It's not just a kind of moving paper around from one side of the Capitol building to the other. But I'll stop there.
May I just have one more second to respond, because I
Sure.
just feel so strongly about this issue. So you can't talk about when the government wants to behave like a hedge fund, and then you stick to the cash accounting that the government does, you're just in for a load of trouble. To quote Peter Fisher, the government is just one giant insurance company. It does its accounting on a cash basis, and that's a disaster waiting to happen. So I just have to say that you can't look at the flows and talk about the capital losses. So we will have to have a longer conversation about this, but it's just, we can't have a money machine in government accounting, which is what we have when we do cash accounting for the Fed. So if you want to really talk about what happens to the Fed's balance sheet, that's a stock concept, not a flow concept. And you can't just talk about that on a cash basis, but I'll let it go. It's my pet issue, and I know other people have a lot they want to say.
Okay, so there's a question from the audience about supply shocks and history. So I'll jump in. In fact, there were two questions. So the question was, the first part is, has the Fed had any history in dealing with supply shocks? And of course they did. There was the Arab oil embargo in 1973, and then there was another oil price shock after the Iranian Revolution. And so the question with supply shocks is, do you accommodate them, or do you let the market adjust? In other words, do you view a supply shock, oil price shock, as a relative price shock? And if oil prices go up, people will cut back on their spending on other stuff. Okay, or do you say, look, if there's rigidities and the prices have to fall, and there are nominal rigidities and prices can't fall or wages can't adjust, then we better do something. So what the Fed did in the 70s was it accommodated them. In other words, it followed expansionary monetary policy to prevent the effects of the supply shocks on the real economy. And what that did was make the inflation worse. So the Fed has had a long history. There was a huge debate about supply shocks, and there are some views on this, and it's nothing new. And the question is now is, what will they do if it even gets worse? And one of the other questions in the chat was, if the war in Ukraine leads to a giant increase in the price of energy, and it's the same issue. Will they accommodate it or won't they? And probably, to the extent that they're worried about the real economy, they may just accommodate it. So yeah, I'll stop there. Are there any other, let me think about this. Okay, questions?
There was another question about kind of did the Fed lurch from one part of its mandate to the other during the pandemic?
Yeah. You or Mickey can take that one. Yeah.
Well, I guess my own view about this was that the framework they adopted in 2020 was much more opaque and much less clear about what their goals were. This is a point that Charlie Plosser and Mickey have made many times over the last couple of years since then. And I think that the way that new framework was operationalized in the fall of 2020 was a commitment to say, we're going to continue these large-scale asset purchases until there's been substantial further progress on employment, is part of why those purchases continued all the way until early this year. And that commitment it simply wasn't appropriate to make such a strong, essentially unconditional commitment. As inflation was picking up last year, it seemed clear that the risk management would have been to start shifting the stance of monetary policy already a year ago, certainly last summer. And I think because of the new framework and setting these very specific benchmarks of we're not going to stop the purchases of this, and we're not going to lift off from the zero bound until that is in fact a big part of why the U.S. economy is where it is today. Mickey, maybe you can add.
Let me toss in the following point. Independent of the question of whether the Fed has tilted more toward reducing unemployment versus keeping inflation low. You know, it was the Fed. The Fed played its proper role. There was a huge negative shock to supply and demand. You had a dramatic contraction of the economy, and the Fed appropriately addressed it in coordination with the Congress and the Treasury. Now, fast forward to the Fed's new strategic plan. I think that the new strategic plan that was rolled out in August of 2020 clearly prioritized employment and enhanced the employment mandate. I think in part because and favored higher inflation without putting any numeric target on either. But I don't know how much that affected the Fed's decisions. When we look at how 2021 or 2020, the economy was really rebounding. 2021, what was so striking in mid-2021, as it was just absolutely clear the labor markets were rebounding back very, very strongly, much more strongly than anybody had anticipated, and inflation was rising significantly. The Fed got caught up in talking about, has there been sufficient progress in labor markets? It was almost as if it was tone deaf to the actual economic data and inflation data. So I think that point supersedes whether they put too much weight on employment versus inflation. They were just absolutely tone deaf to the actual economic data. At the same time, they always talk about being so data dependent in their deliberations.
Yeah. So that's great. We have another question that's come in that I'll let Greg and Peter handle it. Question is, who will replace the Fed as a buyer in the MBS market? Will there be a demand drop for MBSs with the exit of the Fed? What are possible outcomes? So, Greg, you want to weigh in on that, and then Peter.
And MBS is a tough one. My guess is that we're in a pretty low return environment for a lot of safe assets still, and that people, investors will find them attractive. Obviously, they've been not the highest performing investment vehicles over the last year. If you watch your Bloomberg terminal every morning, it's not been attractive over the past year. But I would guess that given their relatively higher rates of return at their modest level of risk, I would expect that private investors and other corporations would find them attractive to step in there. But obviously, there will be an adjustment to the market.
Peter.
I agree with Greg, and I might also go back to what Andy said. I think part of that is part of those dynamics are what will lead the Fed's balance, the composition of the Fed's balance sheet to remain very, very different over a long period of time, even as the overall size goes back to something more normal or more what we thought was normal after 2008. But Mike, I just wanted to chime in on a separate issue, going back to your comment about supply shocks. I agree completely with your historical analysis. The Fed's response to the supply shocks of the 1970s actually contributed to the inflation problem as opposed to mitigating it. But one point that I'd like to make about supply shocks in the current environment is that there's the temptation to say that all of this is bad luck. And it is certainly from the viewpoint of the Fed. They have to take these things as given. But we, that is the American people, do not have to take this as given. A lot of these supply problems reflect policies on immigration, on energy, on fiscal policy, and regulation that are not just miscalibrated, but that are insanely sadistic. What I'd like to see is some evidence that the administration and that Congress are doing something to improve matters, to make it possible for workers to come back into the labor force after leaving during the pandemic, to get business formation and entrepreneurial activity going again, and to make life easier for ordinary Americans. I see no evidence of that. Like many others here in this country, I'm very, very impatient. It's not entirely exogenous. It's not entirely bad luck. A lot of what we're seeing is negative fallout from deliberate policy choices.
Right, but wait a minute. The Arab oil price, the Arab oil embargo was not exogenous either. I mean, it was
Correct.
the great inflation was already going, and they priced their oil in dollars. So the real price of oil was falling. So one reason they set up the cartel was to catch, to recoup the losses that they were making. So
yes, that's right. That's right. So again, the point would be that to some extent, the Fed has to take these things as given, but it's a mistake just to say the price of oil goes up. That's an exogenous shock.
But right. Peter, can I add into the current situation? The supply shocks are, at minimum, make it extraordinarily challenging and difficult for the Fed, because changes in Fed policy cannot affect the supply side of the economy. And so the Fed has to, when it thinks about, now it has to, and we haven't spoken enough about inflationary expectations, but the Fed has to take away the monetary accommodation and tighten enough to slow aggregate demand, just enough to dampen inflationary expectations and break the what we might call the wage price feedback mechanism, but not hike too much to throw the economy into recession. And so it has to now gauge how much of that, what is the natural rate of interest under the current circumstances where some portion of the increase in inflation has been due to supply shocks, and it has to take as given the fiscal and regulatory policies that it cannot influence.
That's right. So the Fed is in a tough spot right now, and but the point would be that it would be a lot less tough if some of the headwinds turned into tailwinds. And that could happen with adjustments to energy policy, again, fiscal policy, regulatory especially.
Just one little thing, Andy, I'm sorry, Mickey, your prescription sounds a lot like fine tuning. I mean, really, how are they going to do all this? Here we're telling them that they should be following rule-like policy, but then they've got all these, boxes they have to tick, and it sounds like it's pretty hard to pull that off.
Well, I agree. However, if, let's say, the Fed were more rule-like, would it be appropriate now for the Fed to say, the natural rate of interest, R star, is 0.05, as the Fed has said in the past, and raise the funds rate directly to the current level of inflation plus 0.5%? Is that appropriate? So I'd say, rules provide very, very valuable guidelines, and the Fed should pursue them. But I think rules can be just as valuable in assessing abnormal situations like we have now, and they may require some modification, but you're still led by guidelines rather than complete discretion.
Yeah.
I guess if I could just weigh in for a moment.
Yeah, sure.
I think that the part of the problem the Fed has made, and some professional forecasters have made the same mistake, is to focus too much on a baseline view. In fact, that's how the Fed communicates right now. The forecast, the summary of economic projections, is a benchmark of each individual Fed official's view of the most likely outlook for GDP and unemployment and inflation, and their most likely outlook for what the Fed policy should be. And that's a mistake, because the whole point here is when we're in uncharted waters during a pandemic and in the aftermath of a pandemic, we know that there's risks. And therefore, the Fed should be communicating what are those risks and what's its contingency plans for responding to those risks. And this is something Mickey and Charlie Plosser, and certainly Mickey and Mike and I wrote. We gave a paper at the Shadow 2 years ago about this. Is the need for doing scenario analysis, contingency planning, and explaining that in the Fed's communications. So that if they had been doing that a year ago or a year and a half ago and saying, we think probably inflation would come back down, but we could be wrong, that would have opened a conversation with the markets, with the public, and with the Congress of what's the balance of risks. And if things go off in one direction versus another, okay, how much regret would there be if you didn't do something? I think what we can see right now is a huge amount of regret that the Fed should have moved toward neutral already a year ago, rather than waiting so long.
Okay. Now, we don't have that much time, but there's another question that came in. And it was kind of related to what Mickey's talking about. The question was, what are the categories panelists use for specific causes on products in price indices? Looking at products, how do you weight the causes impact those products? For example, on fast food, autos, dining, clothing, furniture, housing, and various types of healthcare, consumer electronics. So I guess, you know, Mickey, you've done a lot on this. Why don't you weigh in?
Well, I don't think you could. Look, you can't look at the price of any item and just say that's inflation, because inflation's the you know, persistent inflation's the persistent percentage change in the general price level. Now, I think what we can observe is, you know, as after the pandemic, or not after, but the recovery from the pandemic was driven by the surge in demand for goods, while many service sectors were still closed up or not fully open. So you saw the surge in prices of goods. And now as the economy reopens, you're seeing demand and provision of services catch up. And so you're now seeing this acceleration in services inflation, while goods inflation not only should simmer down, but you could see a little bit of deflation in certain goods items. Hard to handicap all this. I like Peter Ireland's notion that you know that nominal GDP, that is current dollar spending in the economy, it's very valuable as a benchmark, because it is it creates the umbrella under which businesses set their product pricing. And it's also the umbrella under which wage negotiations occur. And so, like right now, it's just obvious, you know, wages are increasing significantly in nominal terms in the service producing sectors that are very labor intensive, and with product demand strong and strengthening, they're going to have, the service providers are going to have flexibility to increase product prices, and that's what's occurring. And so the Fed has to intercede here and say, we have to take away the monetary accommodation and tighten a bit in order to slow aggregate demand that then affects wage and price setting behavior.
Okay. I want to take my prerogative as being moderator and to throw something else into the hopper that hasn't been thrown, and that's political economy. Okay, so the Fed is going to tighten. We don't know exactly how much and how long it's going to take, but we know that once it tightens, it's going to have real effects on the economy. Okay, what are the, what are the chances it's not going to be able to really completely pull it off? Like, what are the chances we run into a situation like we ran into in the 1970s, where they tightened, unemployment went up, and then there was pressure and they stopped? Or what happened to Volcker in the first recession that he was involved with? What are the chances we're going to have something like that happening again? Does someone want to weigh in on that? Maybe Charlie Plosser, but somebody who, thinks about that.
My own personal view is like Mickey said, the urgent priority for the Fed right now should be to move to a neutral stance on monetary policy, not accommodative and not contractionary, just move to neutral. And neutral means that whatever the underlying trend inflation rate has been over the last 6 months to a year, and where it looks like it's going to likely to be over the next 6 months, and then some increment above that. Okay, right now it looks like that's somewhere in the range of 5, 6, or 7%.
Yeah,
and that means that the Fed has a long way to go here. If they could make 75 basis point moves for 8 meetings in a row, okay, that would get them into the right ballpark of neutral. And then at that point, we could start to have a discussion, and the Fed can have a discussion with the markets and the public and the Congress. How is it going to bring inflation back down? Is it going to do an opportunistic disinflation like in the Greenspan era? Or is it going to take a more aggressive approach like in the Volcker era? Okay, but the first priority right now that seems completely unambiguous is to move to neutral, because the longer that they take to do that, the more likely that they're adding fuel to the inferno.
Go ahead.
I was just going to say something super quick, which is, there are a lot of, well, if you have to look at the composition of the Fed this year as compared to maybe future years, I think there are some fairly strong, courageous votes there now to move policy to a tightening position faster. And I think the rub's going to come as we enter the end of the year. We got an election cycle coming up. There'll be a turnover of voting members of the Fed, and that's going to, I think that's going to be the turning point for policy towards the end of the year. How that shakes out, both in terms of the overall election results at the midterm level, but also as we see a new composition of the Fed based on the changes that are currently ongoing in terms of the leadership of the Federal Reserve System.
Hey, Mike.
Mike,
yeah, we got 1 minute. Charlie, are you?
I was just going to say in response to your question, I am worried, more so than I might otherwise have been, that the Fed, what I perceive as the Fed's gradual loss of independence, I am worried that the Fed, if unemployment rates, and we're going to talk some more about this in the next panel, I think, but if the Fed were to face somewhat higher unemployment rates, let's say unemployment went to 4.5% or 5%, or somewhere in the 4 to 5% range by the end of the year or before the end of the year. If that were the case, I don't believe that the Fed will have much appetite to sticking to their guns about rate increases. I think the political pressure will be enormous. And so I think that I'm worried that that the consequences will not be good if those are the circumstances. And I have less confidence than I used to have that the Fed will stick it out, so to speak. And I hope I'm wrong. But frankly, my confidence in that wish, if you will, has deteriorated.
Well, that's what I was hoping you'd say. And I think from then, now we're going to segue.
Hey, Mike.
Yeah.
Hey, Mike.
Yeah.
Can I add something to that before you go to the next panel? So Charlie just talked about his, the Fed's response to higher unemployment. the Fed doesn't talk about this internally now, but I don't think they have any thought of hoping inflation goes down to 2%. I think if inflation, I'm just thinking realistically, if inflation came down to 3.5 or 4% now, they'd be doing high fives and saying, okay, now what do we tell the public? And that's Andy's, disinflation, opportunistic disinflation that Athanasios has written about in the past. So I don't think they have any intention of trying to push inflation back down to 2%.
Right. And they may stick with an inflation target, come up with an inflation target of 4%. So listen, we've used up our time. So I would like to turn the floor over to Athanasios, who is going to moderate panel 2.
Thank you, Mike. So it's you're challenging me to talk about opportunistic disinflation and the high inflation setting right now. I'm not going to do this. I will just focus on the serious challenge that the Fed is facing, because we have this wonderful panel of former FOMC members with us today to discuss. But I will start it in 2012. In 2012, the Fed adopted a clear 2% inflation goal. That was a big improvement in terms of clarity for the Fed strategy. It actually helped the Fed do policy that, in retrospect, it looks to have been quite successful for some time, maintaining inflation very close to 2%, a few tenths down. Then in 2020, it changed its policy strategy. In my view, and I think the view of many members of the shadow, the Fed responded very well in the initial phases of the pandemic, but over the past year, it has run into trouble. So inflation, including core measures, it has been registering readings not seen since the 1980s in the past several months. And what has been extraordinary is the degree of accommodation that the Fed kept adding into the system. Just to remind everybody, until last month, until mid-March, the Fed was not only maintaining the Fed funds rate near zero, it was actually expanding its balance sheet, which wouldn't really be consistent with any sensible monetary policy rule or framework, or even the Fed's own framework, as had been stated in 2012. At the March FOMC meeting, the Fed finally took a first step in raising interest rates, but the questions remain whether a policy adjustment that has been communicated, and quite a bit more adjustment has been communicated since the March meeting, because the March meeting was quite timid. Question is whether this is sufficient to restore stability. And we saw in the previous panel, many of the shadow members suggest that's not the case. On the other hand, the long-term inflation expectations embedded in financial markets are not yet notably elevated. So there is one way one can make the argument that the Fed has been careful not to disanchor inflation expectations. And that's one of the key questions. Are we in a situation where the Fed can handle the current challenge and lead us back to its 2% goal, avoiding a recession? So we have 3 former members of the FOMC with us to discuss this challenge. Bill Dudley, former president of the New York Fed, Jeff Lacker, former president of the Richmond Fed, and our own shadow member, Charlie Plosser, former president of the Philly Fed. I have a number of questions. What I'm going to do is I will invite our 3 panelists to have to give us some initial thoughts among the many open issues. I will state some of the open issues, and feel free to start with any of them, and then we can go from there having discussion. I'm going to start with the obvious one. What went wrong? Was this just a forecast error, as was discussed in the previous panel? Was it a deeper problem with the Fed's strategy, perhaps due to the strategy revision that was adopted in 2020? What should the Fed do to address the current challenge? How much tightening is required? Quite a bit, but views vary, as we've just heard. Is a soft landing possible? How should the Fed adjust its policy if employment growth actually slows down, which is one of the risks that we've just heard in the previous panel? Would the Fed be more likely to succeed in restoring price stability without triggering a recession if it actually adjusted its policy strategy, it moved away from what it did in 2020 and already give us something that may work better in the future? Ultimately, the question is, what would you advise the Fed to do? You've been there, you've been part of the committee. Let's hear your views. Let's hopefully we can nudge the current members of the committee to move in this direction. So we're going to start. Bill, we start with you.
Okay, so the first question you posed was what went wrong, essentially. And as I see it, the Fed made 4 mistakes. 2 mistakes were with respect to the framework, and 2 mistakes were with respect to the forecast. With respect to the framework, I don't have a problem with moving to 2% average inflation targeting. I think that 2% average inflation targeting regime is sensible to help keep inflation expectations better anchored. Where my critique of the Fed is how they operationalized it. And this was talked about in the previous panel. They operationalized it by basically saying we can't raise rates at all until we've actually achieved 2% inflation. We're at full employment and we're confident that inflation is going to be above 2% for some time in the future. That meant the Fed was going to be very late because at the time when the economy was at full employment, the funds rate was going to be at 0. So they didn't have to operationalize it that way. And that, I think, was almost certainly going to get them into difficulty in this kind of environment. They compounded that by what they did in terms of the balance sheet. They basically said we're not going to be able to turn off the asset purchases until we make substantial progress towards our full employment and inflation objectives. And they basically said we're not going to raise rates until we've actually finished buying assets. So they sort of locked themselves into a very slow transition path to moving away from providing accommodation to moving to tightening. So that's why we got this very odd situation that with inflation running 8% year over year, the unemployment rate very low, the Fed was still adding monetary policy accommodation in March, which is just crazy. The 2 forecast problems I think they had, and I would be less critical of them because everybody does make forecast errors from time to time. And, coming out of a COVID pandemic is probably a little more difficult than normal. Number one, the labor market turned out to be much tighter, much sooner than they ever expected. If you remember, through much of 2020 and 21, they talked about the shortfall of employment to where we were in February 2020, and that was sort of their metric for judging how much slack there was in the labor market. Well, we still have a shortfall relative to where we were in February 2020, yet the labor market is extraordinarily tight. And you can just see that by the ratio of unemployed workers to unfilled jobs. It's an all-time record. The second forecast error was, of course, on inflation. They had a story that inflation pressures we're seeing were mostly transitory. It was due to the shift in the composition of demand away from goods, away from services towards goods during the pandemic. And once demand shifted back towards services, away from goods, that a lot of that inflation pressure would diminish. Now, there's no question that a lot of the inflation pressures that we are seeing are transitory. I mean, the increase in used car prices up 40% last year is not going to be repeated in 2022 or 2023. But it's turning out that the inflation pressures are turning out to be much more persistent than they anticipated. And you can see that by things like the Dallas Fed and the Cleveland Fed, trim mean and median CPIs. There's a lot more pressure. And the other thing I think that, that people haven't put enough attention on, it doesn't really matter what the inflation numbers do at this point. What matters is how tight the labor market is. If you push the labor market past full employment, you're going to have a problem because you're going to have acceleration of wages, and that acceleration of wages is going to be an ongoing driver of inflation. That's the thing I'm focused on right now is the labor market seems way too tight and wage trends seem to be very high relative to a 2% inflation objective. So even if inflation does come down over the next year, as the Fed hopes, you're still going to have this problem of a very tight labor market.
Thanks, Bill. And we'll come back to a couple of these issues that you just mentioned. Jeff, what about your views?
Thanks. First, it's a pleasure to join you in the Shadow Open Market Committee. That is a critical time for the Fed, and as a result, this is an important time for the Shadow as well to play its historic role. So what went wrong? I point to two things. There's a lot of different ways to skin the cat. I think I'm broadly in alignment with Bill, but these are two things that were often emphasized by Alan Meltzer in his magisterial history of the Federal Reserve. One is learning the wrong lesson from the last cycle, and the other is applying the wrong model in essence. So the wrong lesson they learned was that they overreacted to the taper tantrum in 2013. And as a result, they were just determined to provide an exceptionally lengthy lead time into ending asset purchases. When they said they were not even talking about tapering, well, that essentially locked them into a multi-step process. It was going to take many meetings to get done. Plus, on top of that, they promised not to raise interest rates until they'd completed the tapering process. And the result was that in September of last year, when it was abundantly clear that the Fed needed to tighten, needed to start raising interest rates, they had tied their hands for 6 months after that, all by their undoing and all out of an allegiance to gradualism that is, in hindsight, quite excessive and something they really ought to re-examine, I think. As an aside, it's never been obvious to me why asset purchases ever need to be tapered when you're going to end them. The wrong model they applied was essentially how they think about maximum employment. They compare the current level of employment to the level to which it will return in the longer run, steady state, after the dust is settled, all of the current shocks have dissipated, and no further shocks occur. That level is way out in the future. So, for example, it would include labor force participation rate returning to its pre-pandemic trend. It's a great measure. It's really fascinating. It's worth knowing, but it's not what's germane to inflation dynamics. And that's the problem. What is germane to inflation dynamics, as we now know, is the relationship between the current level of employment and the employment available to be deployed currently to meet demand, should demand change. And given all the shocks that have occurred recently and up to now and have impinged on the economy. And that's a very different number. So slack, in measured this way in the second quarter of 2021, was clearly zero or probably even negative. But by their 1960s style measure, slack was a sort of a large number. And I believe that this is what misled them into deducing that the surge in inflation that we saw in the first half of 2021 was transitory and not likely to persist. It led them to forecast a decline in inflation, and it led them to make statements that were much less hedged than in hindsight they probably should have been. It bolstered their complacence about a return of inflation to 2%. And I think that's a reason they waited so long. What should be done? The Fed obviously needs to raise rates very substantially and with alacrity. Compelling benchmark is a real federal funds rate at or above zero. The implication for the nominal rate is going to depend on what the prevailing inflation rate is, the most recent actual data and what's expected for the quarters immediately ahead when they get the nominal rate there. Now, I'd point out that the way the Fed talks about, way some Fed officials talk about returning the Fed funds rate to a neutral level is sort of confusing, because some lead you to believe that what they're calling neutral rate corresponds to the longer run nominal federal funds rate in the summary of economic projections. This is the nominal federal funds rate that will prevail in the longer run, steady state, after the dust settles, all current shocks have dissipated, no further shocks have occurred. And as a result, it's a number like 2.5% in the SEP, the summary of economic projections. They could get the funds rate to 2.5%. But if inflation is running at 5%, they're still far from a relevant concept of neutral federal funds rate. I think they need to clarify when they talk about neutral, they need to clarify what they mean by that. And they need to, I think, aim and and clarify that they're aiming for a zero or non-negative at least real federal funds rate. I think 50 basis points should be the default presumption at every meeting. And I think 75 should be on the table for serious consideration at every meeting from now on. If they raise rates aggressively, it's my sense that it's very unlikely that they will achieve a soft landing. I believe they have missed the opportunity to reduce inflation in a relevant time frame of the next couple of years without avoiding a recession. I think a recession is in the cards. The hard part is going to come for them down the road, as Charlie Plosser and Michael Bordo commented. I think how they react when employment growth falters, when demand as it growth is restricted by monetary policy and impinges on the labor market conditions, how are they going to react? What they've released in the March Summary of Economic Projections is an immaculate disinflation, one in which they don't have to face any hard choices. They need to talk to us about hard choices that they might have to make down the road. It would be useful and it would be better for their credibility if they do it sooner rather than later.
Thanks, Jeff. And we're going to come back to the immaculate disinflation. It's a lot of us on the shadow recall when we saw the March SEP, we're wondering, is this even internally consistent, coherent with our understanding of how the Fed used to be doing policy over the past decade or more? Charlie, your views, and you're muted, so you can unmute yourself and give us your first thoughts.
Thank you, Athanasios. It's a pleasure to be on this panel with my former colleagues and friends. It's a lot of fun. I think a lot of what I have to say overlap a lot with both Bill and Jeff. I think we have some common themes amongst us about what the problems have been. Maybe we put a little different spin on them, or put a little different perspective on them. So I'll try to offer some of that as I go forward. You know, the Fed is really in a very precarious position. The country, as we've noted, is facing inflation rates it's not seen in 4 decades, and that's affecting the economy, every aspect of the economy. The Fed dithered around for more than a year over inflation, making excuses that it was transitory or caused by factors beyond its control, whether it be automobiles or lumber or what have you. I found this posturing and conversation that the Fed conducted about this quite counterproductive, because the Fed never acknowledged about the role that policy was playing. And the Fed ignored the fact, or never acknowledged the fact, that both monetary and fiscal policy were more accommodative than they have been at any time, at least since World War II. That's over 3/4 of a century to compare it to. The fiscal authorities were spending extraordinary sums to support demand, individuals and businesses during the shutdowns. Between February 2020 and December 2021, the federal government issued approximately $6 trillion in new Treasury securities, increasing the public debt by about 25% in less than 2 years. At the same time, over 50% of those treasuries, 50% of that $6 trillion was purchased by the Fed onto their balance sheet. So 50% of that new debt, over $3 trillion, also resulted in an explosion of the Fed's balance sheet and a substantial increase in traditional measures of money. On top of that, the Fed was buying something in the order of over $2 trillion of mortgage-backed securities and keeping interest rates at zero. Extraordinary amount of fiscal and monetary stimulus. But the Fed never talked about that. They kept talking about the price of lumber and the price of automobiles, both of which were relevant for people, but their relative price changed. So despite this amount of stimulus, the Fed refused to acknowledge that the persistent rise in inflation had anything to do with policy choices. And that deflected the conversation away from the choices that the Fed and the fiscal authorities needed to make. Many people, including myself, members of this committee, and even Larry Summers, I might add, expressed concerns early on that this stimulus was likely to turn what might otherwise have been a temporary inflation from these so-called supply shocks into something that was more persistent. And that in doing so, it runs the risk of dislodging the stabilizing effects of anchored inflationary expectations. The Fed ignored these warnings for about a year. Yet the Fed, and to some extent the public, had become complacent, I think, believing we had learned our lesson and that we were never going to allow episodes like the 70s to occur. Moreover, sorry, I lost my notes. Moreover, the Fed assumed that the future recoveries, and Jeff alluded to this, and so did Bill to some degree, that all future recoveries were going to look like the post-financial crisis. That was implicit or actually explicit in their development of their new strategic outlook of August 2020. And that complacency showed up in the Fed, and Bill was referring to this as well, and that the Fed rejected the idea that any easy monetary policy could lead to inflation pressures as long as the economy remained below full employment, maximum employment. This strategy, as was mentioned, naturally led to a tendency of the Fed to delay its response to inflation. The result is that the Fed found itself well behind the curve in addressing inflation. This behavior of the Fed, rather than something new, and although the rationale was, reminds me of the old grow-stop policies of the 60s and 70s that we've been so critical of. In those periods, the Fed would step on the accelerator, try everything it could to boost employment, only to find that it had to slam on the brakes to restrain the subsequent inflation. I thought we had learned long ago that such a strategy was more destabilizing than it was stabilizing. Just as I thought we had learned the strategy that monetizing supply shocks can be inflationary, regardless of the unemployment rates. So I'm worried that the Fed has fancied up these old approaches to policy in new clothes, and maybe the emperor has no clothes. I'm not sure. Of course, the Fed is grudgingly now coming to grips with the reality that it has to act to restrain inflation. It finds itself in a dangerous position of having to raise interest rates more rapidly than it might prefer to, and that the risk of a financial turmoil during that rate increase would disrupt the economy and create a recession. Or if they don't do that, they risk losing control of inflation, inflationary expectation. It didn't have to be this way. I'll note that the Fed really has yet to acknowledge that their policies in particular, have contributed at all to the problems. They're just the poor victims. It remains to see how much of credibility the Fed has lost in this process or has been damaged. Credibility, of course, is easy to lose. The Fed's, of course, in a tough spot, mostly of its own making. As it started, many people have said that it started a gradual withdrawal of stimulus a year ago, as it should have, it would not find itself in this position of having to raise rates so dramatically and quickly. But where do we go from here? The committee is now at least go ahead and raise 75 basis points 50 basis points next week. In other words, 75 basis points, and the ceiling will be at 1 percentage point. Now, given that inflation is now running 5 or 6%, as people have pointed out, real rates are still quite negative. And they're a long way from getting interest rates to zero, much less positive. Now, I think that needs to be a focus of the coming strategies. Negative real interest rates would not traditionally be viewed as restraining demand or restraining inflation. So they have a long way to go. With 5 or more meetings left, it will be interesting to see if the Fed is willing to get the funds rate, real funds rate, up to zero by the end of the year. That's going to mean a funds rate target of, somewhere in the neighborhood closer to 4 or more %, because inflation is unlikely to drop that much, even if it begins to come down. So I think they've got a long way to go. I don't know that they have the, what's the word I want? The will to keep after this. And of course, what that means is, will they lose credibility over the next 6 months or gain credibility? If they don't sustain their efforts to address inflation, it's likely that their credibility will be further undermined and just make matters worse. So they've got to deal with interest rates. They've got to deal with their credibility, which I think is teetering on the verge of very questionable. They're talking a good game now, but whether they'll deliver is the real test. And if somebody, as we talked about, what are they going to do if unemployment sneaks up? I think the future of monetary policy right now is quite murky. It's highly discretionary going forward, and the Fed has offered us little guidance as to what its reaction function may look like. The old discretionary argument that trust our judgment, seems to me a lot less comforting now than it used to be. And I'll stop there, and there's lots more to discuss. Thank you.
Thank you, Charlie. This was quite somber. I'm going to actually push you a little bit more on this. You already touched on the assessment of where we are. What would you want the Fed to do next in coming months? That's the question I want to focus on. And Charlie, you already mentioned that you see the Fed funds rate, for example, going to maybe 4% or so, just to keep the real interest rate close to zero. That's one of the questions. It came up in the interventions before. What is the underlying inflation rate that you see right now over the next year that is going to guide us to what it means to have a real zero interest rate? So specific question is, Charlie, you already answered it, but I will come back to Bill and Jeff later on. Is where do you see the Fed funds rate be at the end of the year, the nominal Fed funds rate, which relates to the underlying inflation? Charlie, one thing you didn't address, and I would like you to address first, and then we go to Bill and Jeff as well, is what about the balance sheet? And one thing that is quite interesting is to see the Fed's communication on the balance sheet. I remember in our February meeting, we were complaining that the Fed wasn't saying as much as it should to clarify how much tightening there would be in the balance sheet. Personally, I was disappointed that at the March meeting, this wasn't announced either. But then we see in the minutes of the meeting that there is actually a substantial reduction in the balance sheet in the works. It could be up to $1 trillion a year once they start, but that is depending on the caps they have in place, and whether they should already start doing sales to be part of quantitative easing, especially on MBS, whereas we saw Andy mentioned in the previous panel, that's going to happen very slowly unless they have sales. So, Charlie, two specific questions. Are they doing enough on the balance sheet to do the additional implicit accommodation that would make you more comfortable beyond raising the Fed funds rate to 3-4% by the end of the year, as you say?
Well, let me make 2 points. I think Athanasios, that the minutes that were discussed in the minutes of the March meeting, I guess it was,
yes,
was quite interesting, and there were 2 points that I thought were encouraging. One is that in the minutes, my recollection is there were suggestion or comments that implied that they were open to the sale of treasuries and the sale of MBS, by the way, sometime in the distant future. That was something they had, particularly with regard to MBS, never wanted to say, but they did crack the door open to say that it might happen one day. That was encouraging, and that they do seem to want to reduce the balance sheet. I still think it's very problematic for the Fed about how they define or how they know what the right size of the balance sheet is going to be. They thought it was going to be 2.7 trillion until, a year ago or a year and a half ago, and now it's going to be 7.7. I don't know what 7.7 trillion. Those are big differences in the numbers that are getting created about what the right size of the balance sheet needs to be. They need to communicate more, I think, about the relationship between their use of the balance sheet and their sale of securities or shrinking of securities of balance sheet. What that has to do with monetary policy. There's one theme that says, well, it's all about the funds rate. Monetary policy doesn't have to do with the balance sheet. And yet they use the balance sheet as if they're using it as a monetary policy tool because of the zero bound or whatever rationale you want to use. So I think they need to be more explicit about how the use of the funds rate and the balance sheet relate to one another vis-a-vis, or how they think it relates to one another vis-a-vis monetary policy. That's one part of it. The other detail that I found and so Bill knows this and Jeff knows this. I have long been in favor of paying interest on reserves, but I do think the Fed needs to return to the corridor system or channel system that some people refer to it, as opposed to this ample reserve system. But the other aspect that I wanted to mention that was raised in the minutes that I think is interesting and I think raises some questions is how the Fed is looking at the portfolio, that is the distribution, the allocation, duration allocation of the portfolio in the longer term. As the way they were talking about running off assets, they talked about if the cap is larger than the number of redemptions in long-term portfolio, they would sell short-term securities. What that seems to me is that, and maybe Bill can elaborate on this, but it seems to me is that in addition to the MBS not running off, the Fed is moving towards a longer-term treasury portfolio that's much more tilted towards long-term securities rather than short-term securities. That's just the flip of what it used to be, history. And indeed, prior to 2006, Treasury's portfolio for the Fed was almost entirely bills, short-term. So is it a good idea, excuse me, is it a good idea to have that Treasury portfolio of the Fed so tilted towards long-term, independent of what the outstanding used to be? That is, the Fed used to look for a neutral portfolio of treasuries that kind of matched what the distribution of outstanding treasury debt was. That seems to be no longer the case, and there seems to be a bias to making it mostly long-term and very little short-term. I'm not sure what the rationale for that is, other than to avoid selling long-term securities. or what its consequences might be, and it might be very disconcerting from a term structure point of view. So I was a bit troubled by that discussion. I'm not exactly sure where it was going, but my interpretation of it is something we need to worry about. So A, they need to continue to shrink. They need to get rid of the MBS, and they need to clarify what role this balance sheet is playing for them as a monetary policy tool. If it's not a monetary policy tool at all, why are we still buying assets when interest rates are above zero?
Thanks, Charlie. So let me go to Jeff first, and then go to Bill to answer one of the technical, very New York Fed piece of the question we're going to see. So Jeff, coming back to what you were saying before, so where do you see the appropriate level of the Fed funds rate at the end of the year? And I'm implicitly asking you effectively on what's your underlying assumption for inflation. I mean, it's likely going to come down from the levels we are right now, but it depends quite a bit of where we are. So that's not number one. Number two is what they have communicated on the reduction of the balance sheet, providing sufficient additional tightening that we should be comfortable with that, or what do you suggest they do to the balance sheet in addition to what they've communicated?
So on interest rates, I think they ought to set a pace which they increase interest rates every month and then stop when they get to inflation and see if it's coming down. If inflation's come down enough at the end of the year, great. If it hasn't, they should keep going until
very rules based. I hear you. You want the rule. Bravo.
Yeah. I mean, it seems like and it satisfies their need for gradualism. Maybe alternate 50 and 75, something like that. But maybe 75 every meeting this year. Something like that pace, I think, it is needed to get on top of things and really shift expectations. About the balance sheet, I just don't see any reasonable rationale for holding how much they hold in mortgage-backed securities rather than holding the same amount in treasuries. So you've got a balance sheet, it consists of treasuries and mortgage-backed securities. It should be all treasuries. So when they're reducing the balance sheet, letting mortgage-backed securities run off, given the low prepayment, means they run off much more slowly than their treasuries are going to run off. And that's going to shift the composition toward MBS, providing further housing stimulus, which is not what we want right now, not what the housing market needs. If they feel compelled to limit the rate at which their balance sheet falls, let them sell MBS and put the proceeds in treasuries to reduce the rate at which treasuries run off. So I think they need to bite the bullet and sell MBS outright, even if it means capital losses being realized and wiping out their remittance to treasury. I think they should explain what they're doing and why, and bite the bullet and go ahead on that.
Yeah, that's a very interesting point. And I was also encouraged, and you must have been encouraged as well by the statement in the minutes that opening up the possibility of sales. And I guess for our taste, and I would agree with you on this one, they should have already started. And this idea that only when we are well on the way of tightening, we will entertain the things. That's too slow. Maybe we could add, it's not going to help if we keep seeing housing prices rising even more and then decide to reduce the MBS on the portfolio. This kind of backwards, even from a financial stability perspective, that should be part of the consideration. But Bill, let me come to you, and I'm going to pose a couple of specific questions. So on the Fed funds, where do you see the Fed funds at the end of the year? Where do you see the inflation rate, the underlying inflation trend that would bring us to a positive real interest rate at the end of the year? And then how do you see the balance sheet evolving? And for you in particular, given that you are the New York Fed, where New York Fed is the Fed that has to worry a lot about these things. How do you see the normalization working, and how would the Fed balance the risks of what we saw in 2019, for example, with hiccups in the money market? What should the Fed be looking at? What would you advise them to do in the normalization so that we have the tightening we need, but not get into this trouble at the same time?
So on the federal funds rate, they need to get to neutral sooner rather than later. We can argue about what neutral is. That depends a little bit on where inflation actually settles out. But let's say inflation settles out at 3 to 4, then they need to get to 3 to 4% on the federal funds rate at a minimum. And then they're probably gonna have to go well past that, because I personally think that they're gonna have to have a tight monetary policy that actually pushes up the unemployment rate. And to go back to an observation that Jeff made a while ago, the chances of them achieving a soft landing in this cycle is almost zero, because every time they've had to push up the unemployment rate in the past, we've always ended up in recession. Chair Powell, when he talked about the 3 episodes that where the Fed tightened and that was a soft landing, were a little bit disingenuous, in the sense that none of them did the Fed actually push up the unemployment rate. So 1964, 5, 66, 1984, 85, and 1994, 95, Fed tightened, economy slowed. But during those tightening cycles, the unemployment rate kept declining. That can't happen in this environment if the Fed's actually going to get inflation under control. The good news for the Fed, and I think the thing that's most remarkable, frankly, about the last year, is the fact that nobody's lost confidence in the Fed to any great degree if you look at inflation expectations. So that's pretty remarkable. So maybe that's just the fact that the Fed has done a good job over the last 20 years, and that gives them a little bit of credibility to lose. But it is remarkable. If you had told me a year ago that this is where we were, and inflation expectations would have drifted up only marginally, I would have been very surprised by that. In terms of the balance sheet, I think the Fed has been I think we know exactly what the Fed's going to do on the balance sheet, frankly. They're going to basically flick the switch in May, 60 billion cap on treasuries, 35 billion cap on agency MBS. The caps are going to be phased in probably over a 3-month period. And then that's just going to run in the background. And the economic outlook is going to have to change dramatically for the Fed to change what they're doing in terms of the balance sheet. The balance sheet is just going to run in the background. The Fed doesn't want to have 2 discretionary tools of policy that they could use at any given point in time, because that'll just confuse market participants and create more volatility in markets. So what's going to happen is the balance sheet is going to run off, and assuming there's no shocks that push the economy into a recession, push the economy back to the zero lower bound, the balance sheet will keep shrinking until the amount of reserves in the banking system get down to a level that's consistent with the bank's underlying demand. And that's where we got in September of 2019. If you remember what happened in September 2019, there were 2 shocks to the amount of reserves in the banking system. There were corporate tax payments and a settlement of a treasury auctions. And that led to a discrete drop in the amount of reserves in the banking system. And the banks all of a sudden found out, well, gee, I want more reserves than are available right now. And that resulted in upward pressure in repo rates. I don't think the risk of a September 2019 outcome is very high going forward, for 2 reasons. One, saw what happened last time. They made a bad forecast about what the demand for reserves in the banking system were. It turned out the demand was higher than they thought. So this time they're going to be much more careful as the balance sheet shrinks to not let reserves fall too sharply relative to underlying demand. And the second thing that's really important, but really different from 2019, is the Fed now has a standing repo facility that banks can go to if there's upward pressure on repo rates. So last time, you remember, there was no place for the Fed for the banks to go except to the discount window. The discount window is highly stigmatized. It's not available to securities dealers. So the upward pressure on repo rates was really quite pronounced in September 2019. This time, there'll be a standing repo facility open to the primary dealers. And so if there's a little bit of upward pressure on repo rates, they can go to the standing repo facility and that will cap the pressure on repo rates. It'll also give a very immediate signal to the Fed that the amount of reserves in the banking system are now consistent with the underlying demand by banks. I think the balance sheet thing is going to be extremely boring over the next couple of years. The last thing I would say about the balance sheet is we act like if the Fed normalizes the balance sheet, that's making monetary policy tighter. It's really just removing accommodation. So, if you think of it, what a neutral monetary policy regime is the federal funds rate, add some notion of, 0.5% above the rate of inflation, and the balance sheet back to normal in terms of its size. So, it's going to take 3 years for the balance sheet to get back to a size consistent with the underlying demand for bank reserves. So during that entire transition, the balance sheet's still adding stimulus to the economy. Bond yields are lower than they would otherwise be if the Fed hadn't built this big balance sheet. Now, there's a lot of argument that the Fed shouldn't do any of this stuff with the balance sheet, but I think the argument on the other side is when you're trapped at the zero lower bound and short-term rates can't go any lower, how can you add additional monetary policy stimulus? And the balance sheet, as quantitative easing, is the method the Fed has had to provide additional monetary policy stimulus at the zero lower bound. So I don't really have. I personally think that's a perfectly legitimate tool of monetary policy. I don't think other people on this Zoom call would agree with that. The question then is how do you take it back so you have that available potentially for the next cycle? In terms of agency MBS cells, it's not going to happen anytime soon. It's not going to happen because the Fed's going to follow the same template they followed last time. It's not going to happen because they would have to take losses. And as Andy Levin talked about earlier, the Fed's already at great risk of having their net interest income turn negative just because of how fast they're going to be taking up the federal funds rate. I don't think they're going to want to add agency MBS losses on top of that, because that's going to be a political economy problem for the Fed. And I'm sure the Shadow Open Market Committee is going to bring a lot of attention to when it occurs that the Federal Reserve is actually losing money rather than making money. And that's, I would say, more likely than not as we look out to 2023 and 2024.
Thanks, Bill. Let me just make my own observation on the last point. So we would bring attention to the Fed losing or making money, but I would actually go with Debbie on this one. I'd be very happy if we have best policy, even if it means losses for the Fed temporarily, if it's the best for the country. And I think that's the idea to get to. But I want to point out, so when you say that it may take 3 years to normalize the balance sheet, that is only if they actually manage to reduce it at a fast enough pace. But if they don't have enough unwinding of the MBS, that's not going to happen. It may take 5 years with the current pace, and then that becomes more of an issue. In terms
it could take a little. It could take a little longer.
The
agency MBS cap doesn't really do very much, right? I mean, with rates having risen, the agency MBS runoff rate is really going to be driven by mortgage amortization and people, moving from one home to another, prepaying their one mortgage, taking out a new mortgage. So I think it's probably 25-30 billion a month. That's it on agency MBS. You could have a higher cap, but it wouldn't make any difference to that runoff rate. The treasuries, we know exactly what's going to happen in terms of the runoff rate, because we can actually look at the NERC Fed's holdings of treasuries on behalf of the Federal Reserve System. We can see what actually matures each month. Even that, though, is not going to be as fast as 60 billion a month, because the caps are typically only binding the middle month of quarter. That's when the quarterly refundings auction, securities come due. And so it's basically not binding first month of quarter, binding second month of quarter, not binding third month of quarter typically. So even the treasuries are not going to run off quite as fast as the 60 billion per month suggests that they might do.
Yeah, I hear you, and this is one of the reasons what you just mentioned on both MBS and treasuries. I think we will be coming back to the sales in the meeting for the shadow over coming months. Jeff, let me come back to you. You mentioned, and Bill also mentioned this, that it may be hard for the Fed to avoid a recession given how late they have been in withdrawing accommodation. That is clearly a risk. And the question is, so should we worry that the Fed will compromise on their intention to bring inflation down? This is a question of what happens if the unemployment rate actually starts picking up. And unfortunately, when the unemployment rate goes way below the Fed's longer run estimate of where the unemployment rate should be, this is in the cards. How can the Fed best protect against further erosion of the credibility that we see bubbling up right now, in your view?
It's a tough challenge. I think that the more they prepare markets ahead of time, the better. I mean, you look at what they've said. To their credit, they've shifted their language about the mandate. Chairman Powell and several others have said that price stability is a prerequisite for maximum employment. And this echoes the language that Volcker and Greenspan used when they said that that the best contribution the Fed can make to maximum employment is price stability. So they've suggested a shift and a definite ordering of price stability's necessary. We got to get that taken care of before we get maximum employment. What he hinted at there in that press conference was what would happen if the unemployment rate deteriorated, if the labor market deteriorated. Now, what they've put out in the SEP is this sort of rosy scenario. Push will come to shove when the labor market data actually turns and starts weakening. And that's when you'll see I would forecast a fairly ferocious economic, political pressure on a lot of flanks. And they're going to have to articulate why fighting inflation now and getting back to maximum employment later is better than backing off of their fight against inflation and letting it run for a while in order to dampen the size of a downturn a bit. Because I think that's a recipe of just oscillating at a fairly high level, more volatility, more speculation. Are they going to turn to inflation now? It's a return to stop and go. The other thing I'd mention in this regard with a similar sort of dynamic is financial stability. I mean, there's a substantial chance that financial turbulence could emerge again, widening credit spreads, widening risk premia, widening bid-ask spreads. Those are all the kinds of things that you expect to see in an economic downturn for fundamental economic reasons. But the Fed has systematically pathologized that normal behavior, that normal reaction of financial markets to economic downturns. And they've shown a willingness to intervene quite broadly. And they expanded the precedents 2 years ago with their intervention in the corporate debt market. So my sense is that, my guess was that this is likely to exacerbate the turbulence. There's going to be speculation. Are they going to go into corporate bonds again or not? Are they going to go into munis or not? And the Fed could well feel compelled to back away from fighting inflation in order to stem financial market volatility. They've shown in the past that financial market bumpiness can induce them to ease policy. I think that's a real risk to their credibility as well.
Thanks, Jeff. Charlie, let me come to you, or I'd like to see if we can get specific advice for the Fed given this risk. You also highlighted in your introductory remarks the risk of having the stop-go environment, which is really the concern right now. You're trying to fight inflation. The employment rate will start picking up. Then you may have the political pressure. You may have the concerns about recession. You back off, and then credibility is taking a hit. What's the advice you would give to the Fed to minimize the damage that will come from what we worry about right now is in the outlook?
Well, I think it's very difficult. I think the Fed is in a very difficult position. But as I started out, I think partly it's a situation of its own making. This does look a lot like the old growth stop policies of the 50s and 60s and 70s. And so I think the part of my thinking is the Fed has to do something is to signal something and talk about doing something that recognizes, and I think Jeff alluded to this a little earlier, recognizes that this is not going to be an easy task. They've got to say, as Jeff said, we want to get, and as I said, let's try to get to something that looks like zero in the real funds rate by the end of the year, at least. And that could require, and I think all three of us have agreed, at a minimum, probably a funds rate of somewhere between 3 and 5%, depending on what inflation does. And that the public needs to be prepared for that. And they need to make that kind of commitment and get the public used to the idea. The problem is that the Fed typically doesn't like making those kind of commitments. The Fed made a commitment under its new strategic plan, which was a commitment that was unwise, I think. Jeff alluded to this, and I've written about this in several papers. Kind of a misguided forward guidance that was just destined for conflict. And so they need to detail not just a commitment, but what their reaction function is going to be. What happens? Are they willing to tolerate 4.5%, 5.5% unemployment to get to their goal? They need to talk about those trade-offs and how they're going to react to economic conditions and be more explicit about it. And then live up to them at the end of the day. So I just think the danger is in part restoring credibility, I guess. The danger of taking we'll just do the right thing at the right time. Don't worry. I think is no longer a credible device for regaining their credibility. And they have to do something stronger. So that would be, and I think that's kind of in line with what Jeff was suggesting. And what that exactly chooses to be is something the committee will have to decide. But certainly I would be encouraging them to move in that direction.
Thanks, Charlie. You're actually leading to the next question I have, which is gonna be motivated by a question we have from the audience. And Bill, I'm gonna start with you on this one, and then turn it around to Jeff and back to Charlie. So starting with you, Bill, with the benefit of hindsight, the question from the audience is: had you been the Fed chair over the past couple of years, what would you have done differently? And I want to add to that, and this is why I want to get your views and linking to what Charlie just said, is one of the things that has happened over the past 2 years is the revision in the framework. So would you have done something different on that? And I want you to starting from that to go to the next step. Would you advise the Fed to change the framework going forward already this year? If it didn't work out, let's change it. Why stick with it? But let's start, Bill, with the question of what would you have done differently, and then build from that.
Well, I was never comfortable with how they operationalized the new 2% average inflation targeting regime, because it, by definition, was going to make them very late at some point. If you think about the old regime, you basically were trying to arrive at full employment, 2% inflation, and neutral monetary policy all at the same time. So ideally, if you pulled it off, and I would say the Fed came pretty close to pulling it off in 2018 and 2019, you could just stay there indefinitely. That was a good regime. The new regime almost certainly made it so you almost had to be late, because when you finally realized that you were at full employment and you were at 2% inflation, monetary policy was going to be extraordinarily easy. The new regime also is not symmetric in terms of how you respond to shocks. It's basically very tilted to one side. It's all worrying about inflation expectations getting unanchored to the downside. It's all worried about getting people back to work. It's not worried about some of the risks that actually materialize. So I think you also want to look at a framework that's robust to risk in both directions rather than just one direction. So, I think, there was a comment made earlier about the summary of economic projections and how they're modal forecasts. I think it's also creates a huge amount of, it's a problem, because I think you really want to have a regime that's robust to a pretty wide variety of outcomes, as opposed to just the modal forecast of the committee. So that's really my major critique of the Fed. If they had a more flexible way of operationalizing their framework, they could have responded much more quickly And if they responded much more quickly, the federal funds rate wouldn't be at, half to, quarter to 0.5% today. It would be, probably 2% today. And so they'd be much closer to, moving towards where they need to be. Would that be my critique from the Fed? Look at, the forecast, you're not going to make forecast errors. So that's one that I would put, less criticism on them. I think the labor market in particular was a little bit difficult to forecast. The fact that the participation rates come back so slowly, I think that was, something that was just unanticipated on their part. But how they operationalized their 2% average inflation target regime, that was own goal on their part.
Yep, I hear you. You're reminding me kind of the whole strategy starting even before the Fed had a 2% target and before the strategy was formulated in 2012, going back to the Greenspan years, was to be preemptive and try to do policy to get to equilibrium in terms of the policy setting and inflation and growth in employment markets at the same time, which I thought from the 90s on, it had worked pretty successfully. But Jeff, let me get your views on this. So,
Sure.
With the benefit of hindsight, what would you have done? But I also want to get this question, because you mentioned before you probably wouldn't consider changing the strategy. But why stick with the same strategy if we kind of reach the conclusion that it has not been working for the Fed very well? My understanding of the strategy is that it's being reaffirmed by the committee every January. So I don't see why, as some of us had suggested in the past, every year the committee could be having the staff do an evaluation of what is the simple rule. We also wanted that works in the background. Give us a new benchmark rule. Give us a new adjusted policy strategy every January. Why not? Why wait for several years?
So the strategy framework document, we used to call it the consensus statement, was meant to be a timeless description of how the FOMC was going to conduct policy day in, day out, this part of the business cycle, that part, all the time. It's supposed to encompass everything about how we conduct policy. And before even one business cycle, they initiated a review. And if you review it at like less than, the frequency of half of a business cycle, it's not really a framework document as much as a near-term strategy document. And, so I agree wholeheartedly with Bill about the implementation, that the key implementation statements in the sentences in the statement in September of 2020 took preemption off the table. And I think that reflected a real complacence about what gave rise to the stability of inflation in the 2000s and 2010s. And I think I never really saw a big compelling reason to fix the framework to begin with in 2018. I mean, the idea that people saw inflation target as a ceiling rather than an average, I think is bogus. I think it was made up by people that wanted inflation higher and wanted more stimulus. 1.6, 1.7, that seems pretty close to 2. And before we adopted the framework, we were talking about a target range anyway. So we could have stuck with that. So I think they need to review the framework, but let the dust settle. I don't think they have the bandwidth for it. I think they need to stick to their knitting for the next couple of years and get inflation down, then look at a new framework.
Thanks, Jeff. And I see we're running out of time. So Charlie, I'm going to turn to you to get your thinking about how do you think the Fed should go forward with its policy strategy and the framework? Stick with it, maybe do a temporary fix, go back to the one that you had contributed in the consensus statement we had before. How do we help them over the next several years get back on track?
Well, I think the new statement, the August 2020 statement, was a mistake. It was misguided. They shouldn't have done it. I would have been happy to had they just stay, as Jeff's saying, stay with the statement they had and conduct policy. I think they tried to make it too complicated and tried to do too much. And I agree with Bill that those efforts to implement this more complex, asymmetric average inflation target was not a feasible or a desirable shift. And I think that's what got them into trouble, among other things. But their attempt to implement that led them down this road where it wasn't just that they were trying to take the mistaken argument that the Fed had inflation as a 2% as the ceiling. They now turn that into 2% as the floor in the new system because of the asymmetries. So I think that was a huge mistake and part of their part of what got them into trouble because it led them to do things and delay and delay and delay. What I would have been happy actually had the Fed just said, we're going to do an average inflation target, but they left out all this stuff about asymmetries and trying to micromanage inflation expectations and deal with a zero bound. I would have been happy with the average inflation target. It has its share of problems as well, but it would have been much better than what they did. I also would be happy with sticking with an inflation target as we had. I think they could have made either one of those work. The problem I see is that, like Jeff, I'm a little suspicious about doing this too frequently. But given that this was a mistake, the way to do it now is the Fed would have to admit and acknowledge that the framework was not serving the purpose in which they intended. Acknowledge that it was a mistake and then write down something new and better or return to the old regime and try to fix it. Unfortunately, I don't think the Fed is likely to make that admission. As Paul Volcker once told me one day, used the old expression, he says, well, what I was taught was as a central banker, you never explain and never apologize. I think that that's no longer a viable option, but the Fed rarely ever admits a mistake. But I think to move forward from this, they're either going to have to just wait a bit, or they're going to have to bite the bullet and say, look, this is not working as we intended. It was not wise. We're going to review it and do something else. And it wasn't wise for all the reasons that Mickey and I laid out in our SOMC paper and the paper we wrote back in August 2020. All those problems came to pass. The Fed took the post-crisis era of low inflation too seriously. They took all their lessons from that and ignored the rest of history. They put too much weight on that period. And so I think they've learned the wrong lessons and threw out the lessons that we thought we knew about the 70s and supply shock and so forth. So I think they need to change it. De facto, I think that framework is dead anyway, as a matter of reality. But I think they would be better off admitting that and changing to something more sensible. But it's going to be hard. It's going to be hard.
Thank you, Charlie. And I see we are already over time, so I will not get to any of the additional questions we've had. I will close the session. We actually put a couple of positive spins on this and give some guidance to the Fed in closing. So first of all, it looks like we have a consensus here that the Fed should tighten much faster than they communicated in March. And they have already done that. And hopefully at the next meeting, they will clarify with 50 or 75 basis points. And then I hear you say, let's do multiple 50 and 75 basis points. Let's get to maybe 4 percentage points on the Fed funds rate. And then depending on whether inflation is there, see whether additional hikes are necessary or not. on the framework, one thing, and I think it's Bill mentioned this in particular before, it actually is encouraging for the Fed and for all of us and for the country that long-term inflation expectations are still where they are. And this is the one element of the revision of the framework that I thought was a positive element. If the Fed stays true to adjusting policy in order to maintain long-term inflation expectations close to 2%, as they said they would, and as is consistent with tightening that is not extraordinarily rapid right now, that would be great, and that I would actually help them reduce the cost of disinflation, despite the risks that you have all highlighted of a recession that may be hard to avoid. So with all that, thank you very much, and this closes the panel.